dollar that has lower purchasing power generates higher nominal prices for commodities. We saw that in the decade of the 70s.
Hmm.
It isn't merely that demand for commodities increased during the decade of the 70s. It also happened that the unit of measurement, the US dollar, declined 75% in real terms over the course of the decade. So you need to add to the sins of the past and increasing demand in the future the fact that the unit of measurement, the US dollar, is, at least from my point of view, in inexorable decline. That will manifest itself in nominal commodity pricing.
We're coming to the end of the currency era, which has lasted, the fiat currency era, which has lasted from 1971. They have never lasted for very long in the past. This is really, just about run its course. And we're seeing this. We're seeing this with the acceleration, if you like, in the declining value of these currencies reflected in a higher gold price.
Gold and commodities are being framed as signals of currency weakness, not simply assets rising on their own. The stronger message is that nominal prices can climb because the measuring stick itself is losing value. Rickrule, a veteran natural resource investor known for disciplined speculation in mining and commodities, and Alasdair Macleod, a monetary analyst known for his focus on sound money and fiat currency risk, argue that today's move should be viewed in the context of the decline in purchasing power and the long end of the post-1971 fiat era. The comparison with the 1970s is important because commodities rose while the dollar lost roughly 75% of its real value. That pattern could repeat in a more extreme form if debt-heavy governments choose easier money over real reform. Gold may look volatile in dollar terms, but the deeper volatility sits in currency itself. The practical prediction is that nominal commodity prices are likely to rise as the dollar weakens, even as short-term rallies and pullbacks continue. Real assets, therefore, remain central as a protection against the next phase of monetary instability. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The currency is going down now at the moment. So in effect, it's this chart upside down, if you like. The currency, the rate at which this currency is declining is accelerating. I'm talking about the dollar. We just don't know. We just don't know 1 minute to another whether gold is going to go up, down, sideways, what the currency is doing, and so on. But
here's gold. Here's gold inverted. So it's as you were saying, this is essentially the chart upside down. So
yeah.
This is the value of the currency essentially.
That's the value of the currency, exactly. The rate at which it's falling is accelerating. Now, it's not going to be a straight line. It never is. You've got vested interests, apart from anything else, trying to stop the value of these currencies declining. A little bit of decline, perhaps, can be stomached. Like 2% per annum, which is the guideline for central banks. There is absolutely no doubt which way this is going. It was interesting looking at what happened in Germany in the early 20s. There were times when the dollar Reichsmark rate, that rallied quite sharply, just the same, if you like, it's the other way up from, gold. So if you like, the value of the Reichsmark measured in dollars rose. The Reichsmark was rising. So if you look at it in terms of dollars, you were getting fewer Reichsmarks for your dollars. Now, that move at one stage was a good 25%. But where did it end up? It ended up with 4,000 trillion to 1. Basically, it was on its way to valuelessness, and that is really where these currencies are going. And so, if you try and trade, this is why I always say, trading is for idiots in this one. You'll get it wrong, because people do get it wrong. Like most of the time when they trade it. You've got a wonderful industry trying to persuade us otherwise. But if you trade these things, you will get it wrong. And the answer basically is to understand what the hell is going on. And it is the destruction of currencies. We're coming to the end of the currency era, which has lasted, the fiat currency era, which has lasted from 1971. They have never lasted for very long in the past. This is really, just about run its course. And we're seeing this. We're seeing this with the acceleration, if you like, in the declining value of these currencies reflected in a higher gold price. Remember that gold's purchasing power over long periods of time varies very, very little. I mean, it does vary a bit, yes, but it varies relatively little. All the volatility is in the currencies. Almost all the volatility is in the currencies. And if there is any volatility in gold and silver, it is being imparted into gold and silver by the performance of currencies. You know, the answer is very, very simple. Just trying to trade this one is for idiots. It really is. That would be, I mean, it's, you know, all history screams at us, don't trade it. Just, you know, get out of the risk. And if you see that the cost of getting out of risk drops, embrace it. That's what people should do. But they won't do it because people don't understand that it's not prices going up, but their currency going down. And this is exemplified by, you know, the chartists' view of the gold price. You know, they say that the gold price is going up or the gold price is going down. No. The reason the gold price has gone up from $35 an ounce in 1971 to 4,300, whatever, today, is not because gold has gone up, because the purchasing power of the dollar has gone down. The dollar's down, and it's going to go down even further, unless you can get a Paul Volcker in there who's prepared to completely destroy the economy and ruin all the politicians' careers. I just don't see it.
When I see a hyperbolic chart, up or down, I bet against it. I just can't help myself. In this case, I had fundamentals on my side. I'm not sure that the low is in for precious metals. I suspect that nominal interest rates will continue until this administration loses its courage and forces them down. And a higher U.S. interest rate leads to a higher U.S. dollar. Gold is denominated in dollars. So it wouldn't surprise me, given that you need to consider both the numerator and the denominator, that the gold price falters in the face of higher interest rates. Make no mistake, we can't afford real interest rates. The interest on the U.S. debt and the fact that higher interest rates, if they continue higher, will decimate the long bond market when the U.S. government needs to refinance, and ultimately equity markets and consumer durable markets and the housing market means that eventually, like 1975, the political class and the voters will lose their nerve, and they will sacrifice the sanctity of the U.S. dollar to domestic politics. When that happens, like at the end of 1975, gold will be a beneficiary. Will that occur in 2026? I have no earthly idea. Will it occur? Absolutely. I'm a saver in gold, and I save whenever I have a liquidity event. I'll make a fair bit of money on this conference, and I'll put some of it in gold. That's just what I do. I save systematically in gold, and I'm fairly price insensitive. On the gold stocks, I'm starting to take more risk. We're in a risk-off environment. Gold is down. The gold stocks are down. The ones that are down the most are the ones that are perceived as being riskiest. At the same time that after 2.5 years of increased exploration spend, I'm starting to see some great exploration results.
Mm-hmm.
So I see some drill holes that give me spectacular data. And while the market moves, it doesn't move anywhere near the way it used to move. So I'm increasing rather dramatically my risk appetite. I'm not increasing the amount of money I have exposed too much, albeit I have a lot exposed, but I'm changing the risk. I'm doing the opposite of what I told your listeners to do a year ago when I said emphasize the biggest and the best.
You're lightening up on the majors and putting more.
I'm not lightening up on the majors. I'm making a fair bit of money, and I'm deploying new money, in the riskiest part of the sector. History teaches us that a liquidity squeeze, a sell-off, affects everything.
Sure, in the near term, yeah.
Remember the 1987 collapse. Gold stocks held up for 24 hours. If there was to be a liquidity event, would look immediately at their resource stocks, particularly their gold stocks, which is supposed to save them in times of catastrophe.
Mm-hmm.
And there would be heartbroken and probably thunderstruck to see what will happen to those market caps in the immediate aftermath of a collapse. That's because the sell decision in the collapse isn't made by speculators. It's made by margin clerks.
Exactly.
And they sell whatever has a bid. And gold famously has a bid, so it will be sold. The second part, however, is a bit trickier. To the extent that a market collapse presages, as it is alleged to have done in 1929, a more general economic collapse. That is a liquidity squeeze that affects all industries. Then what you do is you systematically lower demand for resources. Not for all time, but you postpone it. And on a net present value basis, a 3 or a 4 or 5 year postponement at an 8% discount is difficult.
Sure.
The other scenario is one where, as a consequence of illiquidity, the government decides to inject liquidity. They engineer lower interest rates, they engineer easier credit conditions, and they engage in what they call quantitative easing, something that you would describe as counterfeiting. In that circumstance, the policy response to, as an example, an AI-generated crash is artificially but extremely bullish for natural resources.
The short-term picture is more complicated. Higher nominal interest rates can lift the dollar and pressure gold, so the low in precious metals may not be fully in. A temporary setback would not break the larger thesis. It would reflect the tension between market pricing and political reality. The system cannot easily afford real rates because debt costs, housing, equities, and long bonds would all come under pressure. Eventually, the political class is likely to choose relief over discipline. That means lower rates, easier credit, and another wave of liquidity if markets seize up. Such a response would damage the currency's credibility but would support gold and natural resources. The lesson is to avoid trading every wiggle and to use weakness as an opportunity to reduce exposure to paper risk. Physical ownership becomes more important when confidence in credit begins to fracture broadly. Now, let's get back to the interview.
A dollar that has lower purchasing power generates higher nominal prices for commodities. We saw that in the decade of the 70s.
Mm-hmm.
It isn't merely that demand for commodities increased during the decade of the 70s. It also happened that the unit of measurement, the US dollar, declined 75% in real terms over the course of the decade. So you need to add to the sins of the past and increasing demand in the future, the fact that the unit of measurement, the US dollar, is, at least from my point of view, in inexorable decline.
Fine.
And that will manifest itself in nominal commodity pricing.
You ain't seen nothing yet. There's going to be an awful lot of that. It is destructive of the dollar's value. And it's, we're looking literally, I think, in the dying moments of the fiat currency system, because it is led by the dollar. And as we just went through all the other G7s, you can see they're all in the same boat, basically. Some leading, others lagging a little bit, but basically the sense of direction is far higher bond yields with an average. I mean, when you include, remember, you got three of the G7 with very, very high debt to GDP numbers. You got the US at about 125%. You've got Italy at 145 to 150%, and you've got Japan at 250%. The average debt to GDP is close to 120% across the whole of the G7. They cannot take these higher funding costs. They cannot handle it. Yet the political imperative will be, don't care, rescue the economy, which basically means debasing the currencies by QE, massive QE, such as you've never seen before, suppressing short-term interest rates, increasingly funding, not out of bonds, but out of T-bills, 6 months, or 3 months, 6 months, maximum funding, 1 year. You can see this is a slippery slope we're on. It is catastrophic. It'll kill the equity market completely. And what happens then is that the banks who have lent, we've just seen through brokers and also through wholesale money markets and direct to hedge funds, banks have something like, they've got collateral in there, which will be around about 10 trillion. Now, they're not interested in the value of the collateral so long as it covers their loans. But when you start seeing the stock market sliding, these banks are going to sell. They're going to liquidate their positions very, very rapidly, which will accelerate the rate at which the market declines. We're looking at a crash, the only way to describe it. And I think this crash could well be at least as bad in real terms, whatever they may be, as 1929 to 32. And Of course, this time we've got fiat currencies. We're not working under a gold standard. And having fiat currencies, basically, they're, governments don't go bust, but their currencies do. And that is really what's happening. This is why it's so desperately important for everybody to understand that the risk is in credit, which includes currencies, not in real money, which in law, doesn't matter what the governments say, is gold and silver, because there is no counterparty risk, particularly if you possess it. If you don't possess it, that's a different thing. If you possess your gold and silver, you protect yourself from this catastrophe, which is looming, and it's looming really quite rapidly.
The resource stock message is more selective. In a liquidity squeeze, even good gold and mining shares can fall because forced sellers and margin clerks sell what still has a bid. That means a market crash could initially hurt the very assets investors expect to protect them. The better approach is to separate physical protection from speculation. Gold and silver held directly reduce counterparty risk, while mining shares remain risk assets that can be punished before they recover. Still, the longer-term opportunity in resources could become powerful after the forced selling phase. If governments respond to recession, debt stress, or an AI-led market break with massive liquidity, suppressed short-term rates, and renewed quantitative easing, commodities should benefit from both demand recovery and currency debasement. Exploration companies with strong discoveries may offer outsized upside, but only for investors who can handle volatility and position size. The strongest prediction is that fiat currencies will weaken further, bond yields will strain governments, and real assets will become increasingly important as the system moves toward a more unstable monetary reset. That is why patience matters. The first break may be painful, but the policy response after it could create real upside for metals and miners alike. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.